Or what are the key trends arising in Australia for evergreen structures? How's this been driven by global demand? Scott Thomas is joining us from Hamilton Lane. Scott, welcome. Good to see you. First, can I get a view from you on the broader macro picture that we're seeing globally at the moment?
Yeah, well, look, there's a lot going on the macro front. There's a lot of vicissitudes that are happening in public markets, but I certainly think private markets do present a significant opportunity to sort of guard against or diversify against some of those broader public market fluctuations, and there's a great opportunity there for us as a firm to take advantage of on behalf of our clients. So we're consistently deploying into that mid-market space at Hamilton Lane, and we'll consistently do so going forward.
So why do you think perhaps private markets are well placed at the moment, particularly, I guess, given the volatility we're seeing in public markets?
So public markets have historically been a place where you've seen quite a lot of concentration risk in terms of the top 10 companies by market cap do take quite a significant amount of the overall market index when you look through a number of the main market indices around the world, whereas private markets, typically there's a lot more diversification and diversity across industry, whether it be Australia, the US, Europe or Asia. If you look through the number of companies that are generating in excess of $100 million of revenue, there is literally a multitude of 8 to 9 times the amount of companies in private markets generating that level of revenue. So the opportunity set is significant in that private market space, and the reason why we're seeing more and more investors, whether it be institutional investors that have historically been significant allocators into this space for decades, allocating into private markets more and more, but also that private wealth segment really coming up in terms of their allocations in portfolios.
So Scott, in terms of those opportunities then, what and where are you looking?
Yeah, well, there's always opportunities across private markets, whether you're looking at private equity, private credit, infrastructure, real estate, or venture and growth. There's a huge amount of opportunity across multiple regions and countries. But I think if you were to pin down 2 areas right now, certainly venture is an area which is quite interesting. Over the last 2 years, you've seen some multiple contraction in that venture area. It's been a bit of a more of a challenging environment for venture investors to raise capital into their traditional closed-end lock-up funds. But at the same time, you're seeing a real revolution in the form of, say, AI coming through, some fantastic opportunities in healthcare, for example. Tech is always a really innovative space for venture. So we think that there are some fantastic opportunities there for investors to take advantage of in venture going forward. And then secondly, to that infrastructure. Infrastructure is a fascinating asset class, has really proven itself to be an asset class which is protected on the downside, but also given strong and good performance on the upside through cycles. And so as you sort of read through the papers every day, there are lots of mega trends around energy transition or digitization, nearshoring, reshoring. Real assets can take great advantage of those trends. And so infrastructure as an asset class is a long duration asset class. It takes time to build these assets or to manage and manage these assets. So private markets plays a crucial role in managing infrastructure assets. And for investors, that's a great opportunity.
So, Scott, you do have a focus on evergreen funds at the moment. What's the opportunity you're seeing there then?
Yeah, well, evergreen funds or semi-liquid vehicles have been around for a number of decades, and they've gone through a bit of an evolution. So over the last, say, 7 to 10 years, you've really started to see a pick up in the number of these types of funds coming to market.
Just before you go on, can you just explain the definition of an evergreen fund?
So there, as the name suggests, an evergreen, it is a fund which doesn't have a closed date. It persists and allows investors to either invest on a regular basis, or there is some form of semi-liquidity on the way out as well, so providing some liquidity along the way for investors. So it's different to the classic closed-end structure where you typically have a terminal life of, so let's just say 10 to 12 years, sometimes a little bit longer at the moment, but certainly you are committing for up to 12 years into a fund. They invest for 7 years, and then you start to see your money back after a 7-year investment window. Evergreen continues to invest throughout multiple decades. And so the intention of the evergreen vehicle is really there to, I guess, broaden out the opportunity set in terms of the clientele base and give private wealth investors primarily access to what is historically been an institutional orientated investor base. So if you think about the macro lens of where the opportunity set in terms of investors has been historically, there's a Bain Capital report that came out. There's about $300 trillion of assets investable assets globally. Funnily enough, half of those investable assets come from that private wealth or individual level of clientele. Historically, private markets have been in the realm of institutional investors. Some endowments are allocating in excess of 50% of their portfolios into private markets. Now, historically, the performance of private markets on rolling 5 and 10-year windows, going back decades, has outperformed public markets. And the private wealth universe or platforms have started to take notice of that, or have taken notice of that. And so you've seen the evolution of these evergreen semi-liquid strategies, where they've evolved to be more, friendly from a cost standpoint, but also allows investors to, get over some of those issues around investing in traditional lock-up funds, where there's often high minimums. There's often very complex subscription processes. You are committed, so you're not fully committed from day one, but you wait around to get capital called. Capital calls don't exist in evergreen strategies, so it really helps solve for some of those high hurdles on the private wealth side that has historically kept them out of investing into the private markets.
And you mentioned earlier, obviously, that opportunity you've seen, particularly with infrastructure. And you, in fact, Hamilton Lane, you've launched an infrastructure evergreen strategy, that infrastructure fund. Just tell us a little more about that then.
So the strategy has been launched overseas as well as in Australia. We've got a very strong heritage of actually investing in infrastructure as a firm. So private equity is a big area of focus for us. Private credit, infrastructure, venture growth, and real estate are the sort of 5 pillars of the business primarily. Infrastructure, we've been investing in infrastructure for over 2 decades. In fact, we started investing in closed-end vehicles with other key fund managers in the space in 2001. And then in 2006, we started investing into what are called co-investment opportunities. So where the managers where we actually partner alongside come to us as Hamilton Lane and say, hey, would you like to actually go alongside and buy a bit more of this company with us? And so we have a significant co-invest platform, as well as we're a significant player in the secondary market, which has been a burgeoning area of private markets, let alone across private equity, but also in infrastructure as well. And so those 2 areas I just mentioned, co-invest and secondary, combining those together allows us to build a very effective exposure in evergreen structures, and that's what we've built in infrastructure. So over the last year, we've built out an infrastructure evergreen strategy, and it's been very successful in its launch, and it allows private wealth investors, charitable trusts, endowments, family offices, ultra high net worth individuals to get access to that infrastructure thematic, which is very interesting, and on the back of what has been a very volatile period in markets over the last 5 or 10 years.
And Scott, I gather Hamilton Lane has just released its annual private wealth survey. What are the key findings out of that?
So at the end of last year, we asked hundreds of financial advisors from around the world a number of questions around their allocations into private markets. And it's no surprise that private markets are of interest to them, given some of the reasons I mentioned earlier around performance and diversification, and it helps downside protection. But what was really interesting is that almost every single respondent said that they're going to be using private markets in 2025 in their portfolio allocation. In fact, 60% said that they're going to be increasing or having allocations of 10% or more in their portfolio. So that was fascinating. And then if you funnel that into Australia has actually been a very, forthcoming user of evergreen structures for a number of years. We're very enthusiastic about allocating into private markets in portfolios as a country, and the financial advisory community has been big supporters of that. And there's a lot of interest relative to other parts of the world. We're actually one of the highest level. We have the highest level of interest in private markets across the US, Europe, or Asia on a relative basis in the interests of private markets and portfolios.
Why do you think that is?
I think if you think back, the pedigree of our industry, or finance in Australia and funds management in Australia, the superannuation industry is very large. We've got one of the largest pension markets in the world. That has spawned a real interest in investing in Australia. And the financial advice community is quite a sophisticated bunch in Australia, and they've really embraced private markets in portfolios because they've realised the benefits of going overseas, but also going into a different asset type in the form of private markets, because it does give you that more consistent level of return, and it has outperformed over the long run. So there's been that real education focus in Australia over the last decade or so, and I think that's why Australians have been very much more, accustomed and willing to take on a private market exposure.